So the other day I was looking at an article about how to offset risk without bond funds because bond funds just aren't really doing well at the moment. And one article that I came across was talking about puts. Doug, how would you use, now this is a part of options trading, something that we don't really do a lot of typically, but it just seems like an interesting idea to me. How might that work?
Well, and there's two ways, we'll talk about two ways of using options to protect your positions.
Okay.
And the first one you mentioned is puts. So basically what you do is you buy a put at a certain strike price. So let's say you own a stock at $100 a share. And you could buy a put at, say, $95 a share. Now, if the stock falls down to $50 a share, you get to put that stock on the person who sold you that put at 95.
So force them to buy it.
Well, they've agreed to buy it at that price. Now, likewise, though, you paid money for that put. Say you paid $3 for that put. If the stock goes up instead of going down or stays flat, you've lost your $3. So look at it this way. It's kind of like going out and buying insurance on your car. It's a good way to insure your thing. You hope you don't have to use it. You've paid money for that insurance. But if you do, you'll get a new car if it goes down. And in effect, you put your wrecked car on your insurance agent or insurance company.
So if you're buying puts, you could offset risk. So if the market tanks, in other words, you can effectively force someone else to buy the stock at a set price so that you don't lose everything.
Exactly. So now let's talk about another way to kind of add protection using calls. And I do this a lot myself, and we have clients who do it. And that's writing covered calls. Now this is just the opposite. We're actually selling to someone else the right to buy a stock at a certain price, usually a little above the price that we're currently our stock's at. So let's go back to the $100 stock. We could sell a call at, say, 105. If the stock, and we get paid money, say we get the $3 in money. If the
For the contract.
For the contract, thank you. And let's say the stock goes up to 110, I have to give the stock over at 105. So I get to keep the $5 I made, plus I get to keep the $3 he paid me or she paid me. That's $8, so I just made $8. So what you're basically doing is you're kind of protecting your downside with a covered call, because if the stock goes down, I get to keep the $3. So basically, it makes my break even now $3 and less than $197.
I guess one thing that comes to mind is that if you're really attached to that particular stock, like my grandfather, when I was growing up, was really proud to own Coca-Cola stock. Coca-Cola being a Southern company, and I shouldn't have mentioned a particular stock.
Well, that's okay. I think the stocks are all right.
Okay, so he was really proud to earn these certain shares of companies because he wanted to have that affiliation with the company. And if you were doing this option strategy, then that stock might get called away from you in the case of writing a covered call.
Right. So the covered call, it would probably not, if you're married to a stock, then you probably shouldn't do a covered call on it.
Although you always say don't ever be married to a stock.
Only date them.
Only date them.
But let's go back to your grandfather and say, look, my whole life savings is in Coca-Cola. I bought it years ago at $50. It's now at $100 a share. I can't afford to have it go back down to $50 a share. He might be a good candidate to put that put at, say, $95 or $90. Now, granted, you don't want to give up the stock, but let's say it falls all the way down to 50. He put the stock at 95. He can buy it back at 50 and then do it again. So that's an example of where it might make sense for your grandfather to have that.
To do a put instead.
Yeah. So hopefully that answered some questions on how to protect your portfolio on a downside situation. If you have more or would like to seek more information on it, give us a call. We'd be happy to work with you.